How do you get your $1 million deal across the finish line? Picture this, you have the term sheet. What do you need to do to get the deal done? You need to understand that the term sheet, though a significant milestone, is not a legally binding document. The real binding happens when both parties sign the purchase agreement. But before then, investors have to complete their due diligence process, which consists of commercial diligence, which is typically, but not always, done before an investor sends you a term sheet, and confirmatory diligence, which digs into functional areas like legal, finance, and tax. Let's talk Turkey. First up, commercial due diligence. Investors conduct this either in-house or through consulting firms like McKinsey and Bain. What's on the checklist? It's a deep dive into several areas. They scrutinize the market, dissecting its structure, industry landscape, and your position in the competitive arena. Your business model and unit economics are under a microscope. They take a closer look at your value proposition to customers, including interviewing a subset of your customers. Here's a golden rule for you. Always align expectations with your investors. Are you heading into a mostly confirmatory phase post-term sheet, or is there more to explore from a commercial perspective? Then comes the fun part. Confirmatory due diligence. This is when investors aim to uncover risks and mitigants, either before or after the investment. Often, they outsource this phase to advisors for legal, finance, and tax areas. For some, it's a comprehensive dive. For others, it's more of an exercise to check for the skeletons in the closet. If there are adverse findings, it will not necessarily make the deal fall through, but it could impact contingencies that will be incorporated into the binding documentation. This phase usually spans several weeks to a couple of months. Its intensity depends on your startup stage and history. If you're in the early seed round with limited financial history and legal contracts, expect a fairly straightforward process. Check sizes here are smaller, so budgets for advisors to conduct this diligence are also lower. This becomes more of a heavy lift as your company grows. If you have multiple investors in a round, you'll often see your lead investor leading the charge. The other investors will hop on the bandwagon and share the expenses in proportion to their check size. Always nudge your investors to work together. You'll eliminate the need to send the same data multiple times and hopping on calls to discuss the same topics repeatedly. First on the list is legal due diligence. Investors bring in their legal counsel, so having solid legal support on your end is critical. You'll need to work with a leading law firm serving startups, either in the US or locally. Your investors' legal advisors will dig into various aspects, including corporate governance and structure. They'll look at the certificate of incorporation and bylaws to understand the basic governance of your company, cap tables, and underlying shareholder agreements to verify ownership, key contracts with customers and suppliers, intellectual property rights, compliance with regulation and cybersecurity protocols, ongoing litigation and disputes, employee matters and HR policies, including the arrangement of key employee contracts and any labor disputes. Here's a tip. Start organizing your legal documents early and consider partnering with a leading law firm for startups. Next up is financial due diligence. Advisors will scrutinize your financial statements, audited reports, and bank accounts to ensure the accuracy of your business plan per what you presented to the investors during the diligence phase. They essentially want to make sure that you're not inflating your numbers. It's difficult to go through financial due diligence if you're very early on and don't have much history. But as you progress, especially as you start building up to that Series A, you'll be expected to have the basic audited financial statements. Expect assessments like quality of earnings and cash proof analysis. The quality of earnings, or QOE, analyzes the sustainability of your earnings. Is performance at a given time period from principal business activities, or do we have one-offs? The advisor will typically be looking for adjustments that should be made to your financials, which may in turn impact the adjustments of the valuation if you agreed to a valuation based on a multiple for your business. We typically see this more in the later stages. The cash proof analysis aims to reconcile the cash flow from your financial statements with the cash flow in your bank accounts. Investors want to see proof that the cash is coming in, especially important if you don't have audited financials yet. And last but not least, we have tax due diligence. The goal here is to understand potential tax liabilities, compliance with tax filings, and the tax implications for investors upon exit. Remember, consult tax advisors early to organize legal entities and tax structures, not only for investors, but also for founders when liquidity events arise. Confirmatory due diligence can be hard work, so organization is key. Start early and gather your documents, because at some point, your investors and their advisors will come knocking on the door. When it comes to legal, finance, and tax diligence, seeking advisors early on can help you navigate the complexities you'll face down the road. This brings us to the end of the lesson. Thank you for watching, and we'll see you in the next video.